Hello, all. Welcome to our corporate tax return filing series. In this episode, we are going to discuss more about the pre preparations for a corporate tax return filing. I welcome CA Balaram to join with me in this series. So, Balaram, my question is how important are financials and accounts for corporate tax purposes? Any requirements from the city perspective?
Yeah. See, just before getting into that, as a chartered accountant, I was very happy when we saw the corporate tax law coming in or introduced.
Yeah.
The reason being, though we had value-added tax, people or businesses were not looking at financial statements, balance sheet, and profit and loss accounts so seriously.
Correct.
Right. Value-added tax was only on your sales and to some extent on some of the expenses. But now corporate tax looks into everything or every element of your financial statements, right? So the weightage or the importance that you will have for financial statements is going to be higher now, right?
True, absolutely.
So this also tells you that the financial statements or the profit and loss account and balance sheet are going to be the basis for your preparation of corporate tax returns. So the one should maintain the books of accounts under IFRS, International Financial Reporting Standards.
Yeah.
Earlier, it was not so mandated, but now under corporate tax law, it is mandated that every business is expected to follow IFRS.
Absolutely.
So the income that you take to compute the corporate tax or tax income, taxable income, will be a profit or loss as per your income statement.
Mm-hmm.
In your profit and loss account, whatever profit you are having, that profit will be taken as a basis. To that, you will make various adjustments. Any expenses that are not allowed to be deducted will be added back, either full amount or part amount accordingly. Any income which is not subject to tax or exempted income will be removed. So you're making adjustment to that. The profits as per profit and loss account, and then trying to arrive to taxable income.
Correct.
In that process, you will also add and deduct any other adjustable amounts, right? And then you arrive to taxable income. And most of the times what happens is that most of the businesses may have their books maintained or the transactions recorded in AED.
Mm-hmm.
But some of the businesses may have transactions in other than AED, which is foreign currencies.
Right.
So you need to be careful in taking the right exchange rate for accounting the transactions if you have transactions in foreign currencies. So that is also one of the important area to look at. And here especially we need to follow the rates that are given in UAE Central Bank website.
Correct.
That is the official source to refer to for any exchange rates to consider for your books of accounts.
True.
At the same time, in the financial statements, earlier we were not looking at taxes and related accounting treatment.
Mm-hmm.
But now that we have corporate taxes, so we also need to look at what is the tax provision that you will have.
Yeah.
And what are the kind of direct deferred tax assets and deferred tax liabilities that you will have, computation of that. If someone is doing interim accounts, quarterly or half yearly, then also you need to make provision for taxes and you have to compute your deferred tax assets or deferred tax liabilities and accordingly update your books of accounts.
Right.
So the books are going to play a vital role. Every business is expected to maintain their books of accounts properly and maintain them by following IFRS, right? There are various thresholds given for different set of standards to follow. One is about full IFRS, other one is IFRS for SMEs.
Yeah.
But yeah, at the end of the day, you are expected to follow IFRS to maintain the books of accounts for corporate taxes.
Correct. Very well explained, Balaram.
Yeah.
I just want to add a couple of points. There are also, which has been mentioned in the Article 20 of the corporate tax regulation, which basically talks about option for either realization basis or fair value basis. Yeah. So that also will play a very important role when the financials are being prepared. And not only that, I think the most important point which you mentioned was about deferred tax asset and liabilities. Now in this country, since corporate tax was not there, deferred tax assets and deferred tax liability was never being calculated earlier. Correct. So it's a very new feature for most of the businesses and most of the accounting department of those businesses. Yeah. So I guess it is very important for them to understand the concept very well, yeah, and then apply accordingly.
In addition to that, Naveen, with respect to the financial year to which the corporate taxes are applicable, of course, you have to follow IFRS and do all those transaction accounting.
True.
For the accounts before that corporate tax regime, which are considered as the opening balances for your corporate tax regime, there also they have given transitional provisions.
Correct.
So based on which one is expected to make adjustments to your opening balances, especially for the balances where you have balances payable or receivable from your related parties.
Yeah.
Right. So there you are expected to make sure that there's a concept called arm's length pricing, which is under transfer pricing principles. So earlier, whatever transaction, whatever value that you have taken or rate you have taken for the transactions with related parties, not many are concerned about. But now under corporate taxes, you have to make sure that the transaction that you do with your related parties or connected persons are at arm's length or at market value. So in that process, your opening balances also need to be at arm's length. Whatever outstanding balances you have should be at arm's length. If you have not done them at arm's length pricing, you need to make sure that you're correcting those balances and bringing them as opening balances for this corporate tax regime related financial year.
Right. So, Balaram, are you saying that historically this country did not have corporate tax? So, as we know, as accounting professionals, there are many businesses where shareholders keep either sometimes pumping money or sometimes withdrawing money without a proper accounting data, and all those balances get culminated into something called shareholder balances or shareholder current account.
Yeah.
So are you saying that those accounts will have to be corrected as per Article 61 at arm's length? Are you suggesting that?
Yes, I think it is one of the important area because as you mentioned, most of the businesses here or the accounting records that are maintained here, we were not completely following the standards or compliances because it was not required or no one was questioning that. Especially the transactions with related parties and the balances payable or receivable from shareholders. Right. Balances with related parties, as I mentioned earlier, you may not have followed the right transaction value.
Right.
For accounting and recording. The closing balances may not be at arm's length, but now you have to adjust that. Second thing is that the amounts that are pumped additionally by the shareholders or the amounts that are withdrawn by the shareholders from businesses, most of the cases they are accounted under shareholders' current account.
Correct.
You have certain amount of capital as registered capital, which is your share capital, registered paid up capital, whatever you call it as.
Yeah.
That used to be a standard amount. Irrespective of the size and nature of the business, the amount used to be more or less standard of the capital amount. But in reality, if the business is like in a manufacturing entity, where a lot of investment is required initially to set up the business itself, in other countries or in general, you are supposed to account that entire amount which you invested, which you may not take out from business in near future or in a short period, was supposed to be shown as a capital or share capital. But here we were not following that practice.
Right.
Certain standard amount, for example, 300,000 was the standard amount that we used to follow for most of the
Businesses.
mainland entities, right?
Correct.
Irrespective of the real capital that you inject. But now you have to make sure that not just 300,000, but whatever is the right amount of capital that you invested in the business is supposed to be shown as share capital or additional capital. And the rest of the balance which you inject or withdraw from businesses on a regular basis is not supposed to be accounted under equity, but it should go under as a receivable or payable from owners or directors or shareholders. So that classification is something that we need to look at. If required, restate your financial statements or correct your financial statements if it is done for this current year and accordingly show the right amount. In addition to that, if at all if you have any balances, payable or receivable from owners, directors or shareholders, if that is not in the regular course of business, but if it is going to be retained in the business or paid for a long-term basis for the owners, you also need to look at the arm's length pricing or transfer pricing requirements and see whether you have to charge interest or collect interest on those balances.
Right.
In order to make sure that the business income and business profit that you're showing in the books of accounts is right. So that the tax payable amount on your profit is right amount that you're paying.
Absolutely, absolutely. Very well explained. I think this is important, viewers, that the related party balances and the shareholder accounts in every businesses is really looked at in a proper manner, so that the balances stand at arm's length and they stand the test of transfer pricing requirements, because that is, in my view, will be an important area which FTA will definitely look at it whenever
Yes.
they come for the audits.
Correct. Absolutely.
So, Balaram, going forward, what kind of internal systems or accounting changes should business implement to stay compliant year after year?
Yeah. So as I mentioned, every business is expected to follow IFRS. Earlier also we were following IFRS, but
Yeah.
now we have to look at each element of your profit and loss account and balance sheet and make sure that you're really following it. Right. In addition to that, there are certain rules in the corporate tax law itself. Okay. So which considers some of the income items or income or transactions as exempted and some other as taxable. So in your business, you need to analyze and understand whether do you have any income in your entity or in your group, the income which is not subject to tax, which is called as exempted income. If you have such a kind of income, you need to make sure that that is accounted separately
Right.
in a separate ledger and identified properly. At the same time, the expenses also, you have some expenses which are allowed fully. You have certain expenses which are not allowed fully or not allowed partly.
Correct.
You need to identify those kind of expenses and then accordingly divide them. If you are accounting every transaction or all the expenses of a particular category in one ledger, let us say entertainment expenses incurred for employees, entertainment expenses incurred for owners, customers, and suppliers.
Yeah.
These are the two categories. Earlier, there was no differentiation.
Correct.
Now, under corporate tax law, as we know, expenses or entertainment expenses incurred for employees for business purpose are fully allowed to be deducted while computing the taxable income, whereas entertainment expenses incurred for shareholders, customers, or suppliers are not fully allowed to be deducted. Only 50% of them are allowed to be deducted.
Exactly.
Now, in this scenario, earlier you are accounting all the entertainment expenses or two categories into one ledger account. But now you have to identify those two separate categories and account in the respective or separate ledgers, so that at the end of the year, when you look at your trial balance for analysis purpose for corporate tax computation, you know which entertainment expenditure is fully allowed to be deducted and which is not.
Absolutely.
And then accordingly computation becomes easy. Otherwise, you have to go through all the transactions of that ledger at the end of the year and then identify which is allowed and which is not allowed to be deducted fully,
Right.
and then compute. So this extra time that you have to spend should be saved by following or by planning your accounting properly from the beginning. So that's one thing. And so other thing is that the managerial remuneration or salary paid to this shareholders, directors, or C-level category of employees or their relatives. This category of people are called as connected persons.
Yeah.
So any payments that are made by businesses to this category of people, we need to make sure that for corporate tax purpose, they're at market value or market rate. So while accounting those transactions, you need to make sure that you're accounting them in a separate identifiable ledgers, so that at the end of the year, you can look at them and see whether the total amount is allowed to be deducted, or do you have any amount limitation to deduct that for corporate tax purpose and only the balance is allowed. In order to understand that and analyze that, you have to account them in a separate account.
Yes.
Ledger. So likewise, you have transactions which you need to separate. At the same time, you may have expenses which are relating to business. You may have expenses which are not relating to business, maybe relating to the personal purpose of the owner.
Correct.
So now you have to identify them and account separately. So all these transactions, your write-offs and your provisions for doubtful debts and provisions and all those things, you need to have certain specified accounts identified or ledgers identified to account those transactions. Expenses which are having limit, for example, interest expenditure.
Yeah.
You have limitation in deductibility of the amount.
Correct.
You have to account or identify them separately and then compute the limit that you have, whether it is falling within that limit or exceeding that limit. Not only that, some of the interest expenditure which you've capitalized in your property, plant and equipment under a borrowing cost standard, that also will have to be considered for the limit computation.
Correct.
So you need to have the transparency or clarity of each element of your capitalized amount and then which is not allowed and which is not allowed, and accordingly how much is allowed, and all those things. Computations will have to be looked for. So this is the reason why we need to have clear understanding and clear plan in place before you start your accounting when you get into corporate tax regime, or when you are, now that we have already completed 1 year, it is going forward, you should have this plan in place.
Wow, this is a lot of changes. So, Balaram, if I am understanding correctly, it's not only changing your chart of accounts or not only changing the way accounting is done, but there is a continuous education or continuous process enhancement to even the accounting team. Like, the important point which you just brought down, that if there is an interest which has been capitalized under borrowing cost, now while filing the return, if under the interest limit limit expenditure, if that has to be looked at, then that has to be looked at in a holistic manner. So not only your income statement, but you have to also look at what has been capitalized in your balance sheet.
Right.
So that brings an important point, that the accounting staff should be well versed with these changes. Otherwise, the tax returns will definitely be faulty and the taxpayers will have an issue.
True. There are a lot of hidden elements which are expected to look at.
Correct.
Unless you are aware of that, you will not be able to identify.
Yeah.
Similarly, like, if you have interest element in your finance lease or finance component,
Yeah.
correct, that also will have to be considered for this limit computation.
Correct.
So a normal accountant or someone who is not aware of this will definitely not be able to identify it and then compute accordingly. If you ignore this element and later whenever FTA comes for any audit or inspection, then you'll be asked to correct that. So in the audit you'll be asked to correct that, and there will be penalties and additional penalties along with the tax to be paid. So all these issues will come up unless you're really clear about each element or aspect of the law, and accordingly you're complying or computing and then filing the returns, and other things are taken care as per the law.
True. Absolutely. It's a very, very important point, viewers. I think preparation of the books and maintenance of the books as per the standards, as per the accounting requirements is very important, and it is not a one-time job. It is definitely a continuous improvement process.
Yeah.
So, Balaram, one more question I have. Are audited financials mandatory, and how important is having the audited financials for corporate tax compliances?
Yeah. So as we know, the audit is mandatory or has been mandatory on many occasions or for many licenses in UAE already before even corporate taxes.
Yeah.
But of course, it is not 100% mandatory as we know. But as per corporate tax law, the audit is mandatory for two categories of businesses. One is those companies which are incorporated in free zones, who are eligible to be considered as qualifying free zone persons to claim 0% tax on their profits. So if you are falling into that category, audit is mandatory for you. Of course, only when you have audit report, then that's when you will be eligible to get that 0% tax benefit.
Correct.
Second category is that other than those qualifying free zone persons, if you are subject to a normal tax rates under corporate taxes, you are expected to have this audit report as a mandatory requirement if your turnover is more than 50 million dirhams.
Annually,
Of course.
Right.
So there are two categories for which the audit is mandatory as per corporate tax law. Of course, but it is recommended for every business to have their books of accounts audited. That is when you will know what is the right amount of your income, right amount of your expenditure, profits, assets and liabilities.
Correct.
So unless you have these amounts correctly in place or accounted or audited, you will not be able to understand or identify that these limits are applicable to you or not, right?
True.
Likewise, even for your small business relief, you have to have your accounting updated properly.
Yeah.
Unless you have right revenue, you will not be able to identify whether you are falling in small business relief or not.
Correct.
There are various aspects or areas that you will have to look at your numbers correctly.
Yeah.
It is only through audit that you will be able to have confidence on your numbers and then comfortably say that whether you are complying or falling or not falling in those thresholds.